I'll hear all the bleeps. Bleep, bleep, bleep. Everybody coming in.
All right, I'm going to kick this off. Hi, everyone, and welcome to today's webinar, The Future of Fintech, Challenges and Opportunities in a Volatile Market. I want to thank everyone for taking the time out of your day to join us, and I know our presenters are extremely excited to dive right in, so I'll keep introductions relatively quick before handing it off to our moderator, Stephanie Klein, to lead today's discussion. My name is Layla Edamati. I'm a marketing specialist at IT staffing and recruiting firm, Motion Recruitment, and I also run a few of our local chapters of Tech in Motion, which is our international tech event series. For those of you who are joining us for the first time, Tech in Motion is a content-driven community where technology enthusiasts can learn from other professionals, have questions answered in real time, discover new tech, and hear stories that inspire. Given today's climate, we're excited to continue bringing you the insights and advice you need to navigate this ever-evolving tech landscape. If you have suggestions for future webinar topics you'd like to see from us, don't hesitate to reach out. Now, I just have a few housekeeping notes before we kick off. You'll notice that all of you have joined this webinar in listen-only mode. Feel free to submit questions and comments in the chat box on your GoToWebinar panel, and we'll do our best to address them during the Q&A session. Today's webinar will also be available on demand after the live session ends, and you'll receive a link to view the recording within a few hours. We'll also provide additional industry insights, tech trends, and guides powered by our founders at Motion Recruitment following today's session. So be sure to look out for those in your inbox. And I think that's all from me. So without further ado, I'd like to introduce our moderator, Stephanie Klein. Stephanie is a proven fintech executive with a successful track record building and scaling digital lending businesses. Stephanie is the CEO of Bravient Holdings, a leading provider of online credit products and services. She is also a member of Crane's 40 Under 40 and holds an MBA from University of Chicago and a BS in finance from the University of Illinois. Stephanie, I'll let you take it from here.
Great, thank you so much for the intro. And good morning, everybody, and welcome. I'm really excited to be here today as your moderator for this webinar. We have an engaging discussion ahead, and we, of course, have an expert panel of leaders joining us today from the fintech industry. So we'll be discussing some of the recent challenges and obstacles in the industry, how fintechs are innovating to overcome some of these obstacles, and we'll also be talking more broadly about the digital transformation, and finally asking our panelists for some predictions on the future of fintech. So time permitting, we do plan to have Q&A at the end, and as Layla said, we've had some questions submitted in advance, but please feel free to also submit your questions as we go, and we'll try to get to those. So first off, I'd like to start by introducing our panelists, starting with Matthew May. Matthew is the founder of Acuity, a virtual outsourced cloud accounting department. Acuity's cryptocurrency accounting practice assists utility token issuers and cryptocurrency users in developing an accounting infrastructure that can coexist alongside the rules and systems of the fiat world. So Matthew, thank you for joining us. And next, we've also got Margaret Hartigan from Marstone Inc. She's the CEO and founder, and Marstone is an enterprise-ready digital wealth management and robo-advice platform. Margaret previously spent 10 years as a top financial advisor in the Global Wealth Management Group at Merrill Lynch. Thank you for joining us. And finally, Kristen Anderson. Kristen is a product leader in consumer fintech and banking integration. She is the founder and CEO at Catch, a technology startup combining savings, investment, and insurance for people who lack access to traditional employer benefits. Kristen has also helped launch one of the first ever SaaS benefits platforms focused on student loan repayment. So thank you for being here, and thank you to each of you for sharing your insights today. And let's jump right into it with our first question. So Kristen, I'd like to ask you to start us off talking about some of the unique challenges that we're seeing in fintech right now due to COVID-19.
So I think that the challenges really depend on what type of fintech you're in and who you're serving. I think given the impact on consumers and businesses has been very different depending on what your job situation is, what your business actually does. Obviously, fintechs have the same sort of variability, but I think one of the biggest things that has been sort of most unexpected is the overnight scaling of demand. Especially for e-commerce and payments and the sort of things that are happening where people move their traditional buying behavior online basically overnight. I think there was an amazing graph that basically showed it took 10 years for us to get from 6% to 16% market penetration for online e-commerce payments, and then it took us 8 weeks to get up to 27%. So that sort of growth means that there are huge challenges. Anyone who has to do anything related to KYC and operations support, and in general, just managing the infrastructure of that sort of growth in such a short period of time, I think is something that a lot of fintechs have been scrambling. Certainly, we've been scrambling as demand has come in for products that were previously like how to market, but now are just like explosive and digital.
Yeah, so it's interesting. It's potentially a good problem to have in the long term, but certainly can cause a lot of short-term chaos and complexity while everyone's also transitioning to working remotely if they haven't already. And Matthew and Margaret, I'd like to open up the door. I don't know if either of you has some thoughts on, maybe other types of challenges outside of the demand side that either you're seeing in your company or just seeing more broadly in the fintech space.
I think all of us. We're lucky at our company. We're 100% remote workforce in general. So there was that impact that we didn't feel that other people were feeling. So we were feeling really good, when everybody went remote and said, okay, you have to work from home. We felt like we had a competitive advantage. And then they shut the schools, and everybody was like, "Oh, hold my beer," So shutting the schools was the thing that crushed our company as opposed to working from home. So it was really interesting that working from home may not be the issue, but childcare has been an incredible issue in dealing with especially second income earners that are a lot of the child rearing is falling to, which makes up a huge number of the people in my company that we work with. So.
Yeah, along those lines, I would say that some of our clients work with offshore development staff, and I think given how some of the offshore countries have lagged us in Europe with COVID, and then also some other sort of natural disasters in India, places like that, that has really actually been a double whammy for a lot of firms that are trying to keep pace with the demand and deployments, but then having some of their nearshore and offshore partners lagging with technology capabilities and other challenges with their home countries.
Yeah, that's a great point, Margaret, and not just on the development side, but also from, in many cases, contact centers. I know the Philippines and many other countries shut down with short notice. And so, companies having to face going from having potentially thousands or hundreds of thousands of agents to very few. And do you issue laptops and trust those agents out of home, or do you focus on self-service and digital transformation? So I think interesting to see, some companies are probably better prepared than others in terms of their reliance on human beings and contact center for operations, as well as nearshore and offshore development.
Yeah, and to that point was, supply chain too, because I think some people were a little later on their disaster recovery and continuity planning. So then when they went out to go do the laptop order or the VPN or some of these other work from home requirements, there was a 2-month, if not greater, lag. So that was an added kick in the pants for people.
Yeah, we saw that with the data security as well, where we had a lot of our clients and we ourselves had offshore facilities that had biometric security, and you can't bring your cell phone into the office, but you had hundreds of employees that had to work from home, where you had to, rethink all those security concerns, which, everybody's cheese got moved really quickly.
And Matthew, what are you seeing in terms of how companies are responding? Is the focus getting comfortable with security and allowing these agents to work from home in this environment? Or is the focus on actually using technology to streamline and automate some of those operations roles out of existence?
Well, I mean, unfortunately, the realization from a lot of our clients in the US is that we take a lot for granted. There are some basic fundamental, just not having internet at the home or reliable electricity at the home in some of the countries that we've been offshoring to, that we're starting to realize that we take a lot for granted. So we're having to start with an even earlier base level set of assumptions with, do they have electricity? Do they have the internet infrastructure with the bandwidth that we need to be able to even assess, and then you have the physical PPE, do they have can we get the facilities to them? Because a lot of these places, especially for the outsource center, just shut and just wouldn't let people back in. And a lot of the countries had orders where they couldn't go in and get the stuff, and then you couldn't ship people things. So there were just tons of logistic issues that we were thinking through that before we even got to the core issues that we thought of as core, which like security and things like that.
Yeah, great.
Do you think that some people will reconsider their reliance on offshore, and they'll be, when they look at what the risk and the cost was of like lost time and like, investment that they've had to make, that they would bring some of that back onshore?
I think both ways it's happening is what we're seeing. We're seeing, people weren't offshoring because they wanted people face to face, and now they can't have people face to face. So now they're having trouble justifying the cost of having people face, like in the U.S. And then on the flip side, you're seeing a whole subset of people with high security issues saying it's just not worth it, right? So I've actually seen both extremes start manifesting itself with our clients, where we're seeing people accelerate their offshore plans in the places where it doesn't matter, the security is not as big of a deal, and then where security is a big deal. Security is one of the key issues. There's several other key issues that people have. So.
Yeah, interesting. And Kristen, you alluded earlier to, different sectors are actually feeling a different impact. So I would love to hear you talk in a little more detail about how some of the different sectors of fintech are being impacted, in some cases potentially positively and in others negatively.
Yeah, and I think that the biggest challenge that we've seen between MMBs and SMBs and consumers is basically the same, which is that income basically evaporated. It just stopped coming in. So that's revenue for small businesses, that's paychecks for individuals. And so that problem was the same, but I think as far as fintech is concerned, the impact that same problem had is very different depending on what you do. So part of what Catch does is a savings product, right? So people set aside money for their taxes and time off and all those sorts of things. Naturally, as soon as consumers stop earning an income, savings is where they go for a supplement. So operating in savings, you're seeing balances drop, you're seeing interest rates have gone down significantly. And I think that there's been a challenge in fintech that relies solely on savings in that way. And the investment space, obviously, the volatility of the markets has been pretty, I'm not a financial advisor, but what I will say is that the volatility of the markets is not really reflecting what most people think should be happening right now. And so there's just been a lot of uncertainty in terms of how that affects businesses that run on AUM models, like that you look at the graph and it says, okay, this looks like a V-shaped recovery in the markets, but then we look at the unemployment and it doesn't seem to match. And so I think that like anything that's operating off of trading or investments, there's just a massive question mark still, because I think people are seeing that the expectations they would have for the market aren't really reflecting what stock prices look like. On sort of the lending side, Catch doesn't do lending, but I think you see that SMBs, just being a small business ourselves, that SMBs are looking for lending products, that there is a need to supplement revenue and payroll, and obviously the PPP program to be able to keep the doors open for as long as possible. And so I think across those different industries, in some places demand has gone up, in other places it's gone down. And then in the final category, insurance, we sell health insurance, and as you can imagine, 36 million people unemployed in a couple of months. The number of people who lost health insurance has skyrocketed, and therefore individual health insurance sales are going way up. So you've got kind of the full gambit of like different segments being affected differently. And I think that means that all of our businesses have had to respond to a lot of, moved cheese, right? Like everybody had their cheese moved very, very quickly. And it really depends on whether or not you're chasing after like the demand that's coming to roll you over, or if you're like scrambling to make sure that you can still earn some revenue at all.
Yeah, and Margaret, just given your background in both traditional and digital wealth management, robo-advisors, I'd be curious if you have anything to add to the trends. Are people pulling money out? Are some people investing more? Are some of the people who like to trade rather than diversify and leave it, having a field day and actually more active? What have you seen in terms of trends in that digital wealth management space?
Well, both. Actually, you see a lot of people thinking, hey, maybe the market overreacted at one point on the downturn, and they went in and speculated perhaps on what they thought was oversold. I think you see other people panicked and actually redeem money. But I think firms that don't have digital onboarding and the ability to open, fund, redeem, it really have felt quite flat-footed here. Digital platforms, whether it's insurance like Kristen's doing or other things, frankly, platforms like this became not just a nice to have and something to serve millennials or the digitally native, they actually became really important for disaster recovery and continuity plans. And I think if you look at the statistics of like the big custodians and wirehouses, the robos actually have done quite well from a volume and account opening standpoint, whether it's Robinhood, Betterment, or others. So I think people are waking up to those lessons. So again, it's been both sides, and some people think the market is seeing things that the rest of us don't, with payrolls and joblessness and uncertainty, but certainly uncertain times.
It's interesting. So there's some clear, I think, winners we're hearing. Certainly even looking at the public markets, payment companies like PayPal and Square are outperforming. Consumer spending is down, but almost all the spending is happening online now. And Christine, you shared a great stat there. You've got some other companies in my space, in the lending space, almost everyone is still trading 30 to 50% down, even though the S&P is back to fairly flat actually year to date as of today. We'll see tomorrow or in a week, obviously that can change with the volatility. And then the small business lenders, separate from consumer, such as OnDeck, have certainly been hit the hardest, as well as some of the private companies like Cabbage that have been in the news. So really interesting to see in the long term, where you've got some consumers going all in and some pulling out. How will that play out for robo-advisors? Some of the other sectors, such as the challenger banks, I think time will tell, but really appreciate everyone sharing their perspective on different sectors. I do want to touch a little bit now on the government stimulus side, because we've talked about loss of income, loss of paychecks. Obviously, the government has stepped in, $2 trillion initially under the CARES Act, I think another 500 billion or so since then, and other bills still kind of making their way through the House and then the Senate for additional stimulus. But Matthew, I'd love to hear your thoughts on some of the complaints that, hey, yeah, the government approved these dollars, but the dollars aren't getting into the hands of the people who need them. What have been some of the challenges with deploying those funds that were approved pretty quickly and early on in the crisis?
Yeah, we were like on the front lines of this, because we had we've helped people, about 300 applicants we have about 400 clients. About 3 of them ended up applying for the PPP or EIDL programs, which are the 2 biggest programs. So we got to see firsthand like the diversity of practice amongst the banks, and just with sketchy information. The biggest complaint was there was lack of information, lack of clarity, hastily put together, which is like all symptoms, ironically, of somebody moving fast, right? So you say you don't move fast enough, but you can't criticize if it's hastily managed. So one of the things we've been trying to calm people down and say is, remember, especially the PPP loan in particular, the government force-fed a program that was traditionally doing, I think the historic number, they traditionally did $30 billion a year in a year in a program, and they said disperse 10 times that in the first run, 10 times that in a 14-day period, which I think they did in like a 14 to 21-day period. They did 10x the volume through the program that they had initially set out. Again, now with the second tranche, ironically, with some of the rules changes, there's a lot of speculation that the government's created a bunch of uncertainty, and that uncertainty has kept people from doing that. Big frustrations have been with, and you can go on both sides of this. Let's use the example of Ruth Chris, right? A public company that was clearly eligible under the rules, right? They had a business that was impacted substantially, right? They requested amounts under the rules, right? And then they got a bunch of blowback because they were a public company. Well, there was no carve out for public companies for this, and the affiliation rules were well debated throughout this process. There's just public pressure then, created this then, like Congress always does, like this blowback, and then these people, had to give back the money, or were pressured.
Not only do you have confusion over who's eligible or not, because like you said, they moved quickly, which everyone I think applauded, but the flip side of moving quickly is some gaps in and some
Right.
maybe carve-outs that weren't fully thought through, you've now got companies also having to field the PR challenge, quite frankly, and the PR blowback, even if they're eligible. And Kristen, it looks like you might want to jump in with a thought here.
Yeah.
Oh, Kristen, I think you might be on mute.
I am.
There you are. Hello.
I think one of the things that's important to remember on this is that PPP stands for Paycheck Protection. And I think the purpose of the program seems to have like evolved a little bit. And the changes that were made sort of after the initial capital allocation, after the initial tranche of loans were actually distributed, was that there was this idea that the loans were meant to keep people in business. And that's not what the loans were meant to do. The loans were meant to keep people on payroll. And those are different things. And you can say, well, money is money, it's in an account. But I think there was this idea that like, well, if you're a publicly traded company, you have access to capital through the markets. And so if you need capital, you should get capital through the markets. But that's a very different conversation than would this loan allow you to keep people on payroll that you otherwise would have laid off? Because being able to go to the public markets doesn't necessarily mean that it's your fiduciary obligation to keep people on payroll. And so I think that's a very important nuance that like, I think people in fintech fundamentally understand that, but I think a lot of businesses and a lot of people who were pushing back on this really missed that point, which was to say, well, they could go get capital from somewhere else. And sure, they could, but they have a board, they have shareholders, they have a fiduciary obligation, and that doesn't have anything to do with keeping people on payroll. So it's not really necessarily the appropriate choice to just go to the public markets and say, we need more money so that we can keep people on payroll, versus like what the PPP was supposed to do was to keep those people earning a paycheck rather than on the unemployment rafters. So I think that was a really important miss that they started to change the definition for over time.
Yeah, no, it's a great distinction. It's interesting as well, though, because you've got businesses like restaurants saying, well, wait a second, you know, do you want us to keep people on payroll who aren't working? Right? I think initially the thought was if people are able to work, but revenue is down, keeping those employees on the payroll. Now you've got a situation, and we talked about this prior to the panel, where someone making 50K or so or less can earn not only full pay, whereas employment, you know, typically is generally in most states, let's call it under 50% of your paycheck, but with that extra stimulus of $600 a week, you've got a lot of people, more than half, I believe, earning more unemployed than you know, being paid. And so that brings up interesting questions, and I'm sure we've all read the articles about people who actually did get a PPP loan and their employees are saying, wait, I don't want to come back to work. I'm earning more money to sit and like Matthew said, and my kids are at home. I don't have childcare. So, you know, I think the timeline is also interesting. It was supposed to be very short term, 2 months, but the money takes a while to get into people's hands. And a lot of businesses are saying, look, I want to use this money to bring people back to work once I can open, but using the money to just pay people to sit on the bench when they could earn more on unemployment doesn't make sense, because how do I pay rents and how do I pay vendors and other bills to keep the actual business afloat? So a really complex and interesting issue. Let's maybe switch gears a little bit from that and move on to talking a little bit about digital transformation. Obviously, this is not a new topic, but you know, certainly it's a topic that's still relevant, maybe even more relevant today. And Kristen, why don't you jump in on this one and talk a little bit about just that general trend of how cloud has changed, how fintechs operate compared to some of the more legacy financial institutions?
Well, I guess it depends on when you're talking about a fintech having started, but for a lot of fintechs, it wasn't actually a transition. It's that we were cloud first from day one. You know, our DevOps is cloud first. Our infrastructure is code, right? We don't operate in the same way that a lot of the legacy institutions do, which means that for us, we weren't a remote first company. We did 1 day a week remote to allow people to, you know, get some space, not have to commute, but we did 4 days a week in the office. And the transition to remote for us was easy. The security had already built in place. Like we'd already done all of those things. Being cloud first means that you have massive amounts of agility in terms of where you are, what you deploy, how things are running, in a way that I think a lot of the legacy institutions, and not to really pick on banks, but to even look at the government itself, the unemployment system, right? Like the challenges that they've had in their code. And I think the ability to find programmers who even know the languages that most of these systems were coded in is getting more and more difficult. And so I think that there was just like a massive realization that digital transformation is not really optional, because a lot of new companies, and fintechs being sort of leading the way among them, have been cloud first since day one. Companies like Stripe and Plaid and all of these like massive billion-dollar fintechs are just not at all weighed down by these sorts of changes, because their entire existence is virtual in terms of their product and their code and all of their IP and everything like that. I can't speak as well to the legacy process, but my understanding is like even things like processing PPP applications at certain banks was very difficult because the processes weren't digital. So I don't know if anyone else has things to add, but I think it's been a bit of it's a nice win for a small startup to be like, yes, like we finally, like we got one because we were cloud first and it finally worked in our favor, where the others, like Margaret said, were a little flat-footed.
Yeah, and I'd love to hear from Matthew or Margaret. I mean, how do you think some of these more legacy institutions catch up? Do they overhaul their technology internally and hire people and build it? Do they partner with fintechs? Do they actually acquire a company? You know, valuations are potentially down right now. We see it's hard for these VC-backed companies to raise, and some of those that are pulling off pretty impressive fundraising even during this time are certainly taking a haircut on valuation. Anyone have any thoughts on, you know, how the fintechs sort of cloud first mentality from day one could be leveraged by some of those larger financial institutions?
Sure. I think that it's kind of a loaded question, because it depends on the industry, like, you know, where you are in financial services and what the legacy system you're talking about is. I mean, if it's a big core technology company or a service or a custodial stack, it's almost like a big electric grid, right? It's very complex. It's a very highly commoditized piece of business, but so many people draw power from it. And to Kristen's point, they're like Cold War legacy systems, and people aren't even sure where the bodies are buried who work on those. So while the desire and ambition might be great to, like, you know, bring in, you know, Kristen or Matt or some other amazing, you know, fintech CEO to like overhaul, there's so many interconnected pieces, and the unintended consequences of pulling out the wrong piece is quite dramatic. But what I think what this where we are in the cycle of both the economy but also innovation is that it really reminds me in a way of like big pharmaceuticals and biotech in the early 2000s. And what I do think you're going to see is innovative companies have proven the space. This trauma has proven the resiliency of these new technology transformations, and they're not more risky. In fact, in some cases, they demonstrated that they're more resilient, more scalable, and they basically also give you an electronic audit trail of like activity and breach quite quickly. And I think you're just going to see a lot of consolidation here. So it's kind of, I'm old enough that I was part of the .com boom and bust. So I remember, you know, when it failed in 2000, people said it's over. But what it was is like, no, the space has been proven, and now all the incumbents are going to come into market. They're going to buy, for lack of a better word, the R&D of small companies that have proven something. They'll take the lessons in and they'll bring them in-house. So it will forever change the way everything happens. We conduct business, we transact, how we work, whether or not any of us are getting on planes for board meetings anymore. You know, is that really, everything's changed. So everything will be overhauled. We'll probably see open table for everything, like going to the supermarket, to going to the beach, to like going to TJ Maxx, whatever people are into. And it's just going to, all of these early innovations are going to be applied everywhere, I think.
Yeah, interesting point. And Matthew, just given your area of expertise, I do want to talk a little bit about cryptocurrency adoption and what your thoughts are on how COVID-19 might impact that space.
Well, it's a really funny time to talk about, like when people ask me, I got into crypto early, so like people would always say, tell me about cryptocurrency, why should it be a real currency? And I'm like, well, when I describe you Bitcoin and what Bitcoin is like how is that different other than a government says it's worth something, right? So we're in this fascinating time where governments are literally printing money, like left and right. And you have a thing like Bitcoin out there that actually just went through its halving, which is like half as much as being released by miners. So you have these like macroeconomic indicators now, like where you've seen like where the Bitcoin people are saying, see, we told you so. Like these governments just print money when they need money. Like why don't you have this stable value system? So the biggest thing about cryptocurrency is they're trustless, right? So I think a lot of governments in this COVID situation also have lost trust for people. In that situation, decentralized currency is very fascinating. Now it comes with all the risks of, like, especially if you're not talking about like a Bitcoin or something, like some of the secondary cryptocurrencies with the 50% tax and like all those kind of stuff that can happen. But it's just a fascinating time to see the macroeconomic situations transpiring, like some of the white paper talked about. So.
Yeah, great. Well, let's shift gears a little bit and let's talk about what are some of the opportunities, what innovation is possible. And Margaret, I'd like to start with you. Just given the current climate, how do you think this might accelerate innovation? What are some new opportunities, and how might fintechs be shifting their strategy, their business model, or their roadmaps to accommodate what's happening now compared to what they might have planned for a few months ago at the beginning of the year?
Well, I think all of us are going to have to really be reflective and ask the question, what do our clients most need right now, and how do we respond to that? And I do think that in some cases the fintechs have to be also almost have like an advisory arm or a strategy arm for some of these organizations to really come up with a really airtight plan. Because I think what happened when the markets were really exuberant and people had fear of missing out, or you had these big innovation teams that may or may not been connected to P&L of an actual business unit, you could get adoption and then it wasn't sponsored by a piece of the business and it could flounder, or you could get caught up in someone's wash cycle of a reorg or what have you. I think now, especially since everyone's remote and these are going to be, the fintechs that are going to be adopted are going to like ease something. They're also going to probably reduce cost and they're going to add scalability. And therefore you have to have a pretty concentrated attack plan amongst different business units. You have to have really clear plans about how it's going to be measured, how it's going to tick and tie with other service lines that the client may want to also get to. So I think right now that we're going to have periods of time where we help them strategize so it'll be successful, because what in this environment, to be engaged with a client that doesn't have a really clear plan of how it's going to be used could be actually also another big risk for us, because we're not consultants, right? We're not looking for scope creep or whatever. We get paid typically when there's adoption and usage on the platforms. And so we have to be mindful that they're committed and they have a really good sense of what they want to do. So I don't know if that's a good answer, but I don't think it's necessarily going to be immediate sales or immediately changing your product offering, but I think it's going to be helping them articulate like the value proposition, both internally as an organization to adopt it, but then also to the client base in a more effective way versus just being a vendor or a platform. I think we have to be more strategic partners.
And Kristen, do you want to jump in with some ideas? What does it take to be successful in this climate? What will distinguish the winners from the losers?
Well, I can tell you what I hope it is. I think one of the most important things that can come out of this is a really serious look at rethinking regulation. I think that it's, everyone becoming remote, everything going digital is showing that a lot of like existing regulation is maybe not serving the needs that it could or should. My hope is that the winners are going to emerge by being ones who are willing to be part of those conversations early. It's very classic for the Silicon Valley tech startup to like ignore regulation until they're Facebook size, and then they're sort of sitting in front of Congress and trying to like justify everything that they've been doing for the last 15 years. I think our approach is a little bit different. My hope is that we have an opportunity to talk about how these technologies can actually solve problems and how that some of the historical regulations that have been put in place truly are more cumbersome than beneficial, because we can achieve the same outcomes with different sorts of technologies. So, to give an example that I talk about a lot, disclosures. I think that like there's just a massive amount of disclosures that, while extremely well intentioned, the idea of consumer transparency is an objective worth fighting for, but the existing disclosure system that we have doesn't necessarily achieve that end result. Ask a consumer if they truly understand the bank account or the investment account that they just opened, even if everything that they legally were required to know about is listed somewhere where they have access to it. And so I think there's a really awesome opportunity to say, okay, in this new world, like how do we put in place regulation that fits with the technology we have. Another example that I talk about a lot is Regulation E and the necessity of having like a phone number associated with an account where there's any sort of customer relationship for financial funds. We obviously are not a bank, but we still fall under a fair amount of that because we work with a bank partner who is the custodian. So we have to have a phone number. It's not a problem. It's not typically how most tech startups operate. We can chat with our customers much quicker via email or via instant chat or all of those sorts of things. And if you look back at sort of the initial creation of the regulation, it was in, I believe, 1973. Someone can correct me on that, but it was in the early 70s. And the purpose of the regulation at that point was to say you have to have a phone number because that's a faster way for a customer to get in contact with you versus mail or in person. And so the phone number was the leading technology at the time, but it's now been 50 years and phone numbers are now sort of the antiquated piece of technology of saying you have to be able to get on the phone with someone. And so it's just a very specific example where there are a lot of these things where at the time they were created to be leading, now they're lagging, and the end result of like customer protection and transparency and all those sorts of things are maybe being missed out on, and innovation as a result is much more difficult.
Yeah, it's an interesting point, and we've seen the government move very fast and even accept some challenges and implications of their haste with stimulus. The question is, will they take that same approach to the broader regulation? And, will there be a push to catch up the regulatory frameworks that often, to your point, are, they were leading decades ago and they're just not anymore. And time will tell. And Matthew, curious to hear from you as well. What does it take to be successful post-COVID? What will distinguish the winners from the losers?
I think the big thing now is a bunch of people have a leg up and a bunch of people have a leg down. And I'll give you like an example just from PPP. Like Wells just did terrible. Like they responded horribly to it. And then you have a small company like Lendio, like knocking it out of the park. Well, that was a small win, right? But so you're going to have to take stock, each of those companies, like the winners and the losers, like the pre-winners and the pre-losers, are going to have to take stock and say, okay, if I'm Lendio, how do I then maximize it? Because every single entrepreneur I've talked to said, I'm moving my business, all of my business away from Wells because they did that poorly for me. Well, that's fun when they're saying it right then, but Lendio's got to capitalize on that, right? If you got the PPP loan, how do you transition that to like recurring relationships? How do you take that and go the other way? And if you're a loser, you're not completely done, right? You can recover. Like, what's your strategy to recover from that? So I think the winners and the losers are going to be decided for the next step. Like, just because you were in front of it right here doesn't make you a winner. Like, a lot of times people didn't do a lot of monetization of the winner time right now. So now you have to monetize that and turn that into long-term relationships and trust and build on that. You're in a better spot. I'd rather be the Lendio, right, that responded fast and like, but if you don't do anything with it, you're really not a winner in this situation. So that's going to be really interesting to watch.
That's a great point, and it brings to mind a conversation I've heard over the past year, which was, the fintechs represented somewhat of an unbundling of features. So a lot of these fintechs, in the early days, they focused on one thing. And the question is, have we now been moving toward a rebundling? And to your point, so that's great. Lendio did an awesome job. They earned a lot of trust and respect from their customers for PPP loans. But can somebody really switch from Wells Fargo to Lendio if Lendio doesn't offer full service banking? And right. So that's going to be, I think, something to keep an eye on. We talked a little earlier about consolidation as well, and maybe some large companies buying the fintechs for R&D and for IP. What about companies merging? Is there an opportunity for fintechs to merge and, rather than building all those products themselves, merge with someone to offer more of a full service so that that challenger bank, whether it's for consumers or small businesses, becomes more full service and becomes more attractive? Obviously, these days, there's also banking as a service, where a lot of these, community banks, you can white label their, checking accounts. And so you've seen people like Acorns, where day one, it was just sort of, we'll round up your pennies and put in a savings account. And now it's moved on into investment, and they're offering, debit cards and all sorts of other products. And many of these fintechs are really just the digital wrapper, right? And the white label around core banking. Anyone have thoughts to build on that idea, or just predictions in general for the future? Kristen.
So you basically just described the thesis of Catch, which is to say that the last decade was unbundling and that now we need rebundling. I think one of the things that's most important as we look at rebundling, though, is it's not just putting together the existing packages that banks have created already. It's not about creating these separate like P&Ls and the same sort of like rigid structure that's created the, the last innovative cycle of banking in the, 80s and 90s. I think Wells was the one that was like first leading the way. Granted, this got them in a bunch of trouble, but it was the like, oh, like cross-selling, right? It was all about cross-selling. That was the banking model, right? I think that the rebundling trend that we're seeing now, it is like critically important that we approach it fundamentally differently, because the thing that like in order to be able to compete with like these large financial institutions, you have to have some sort of an advantage. And just like one of the challenges that I see with challenger banks and neobanks is that they are just the digital wrapper. They're taking on customer acquisition costs, customer support, like they're taking on like ongoing issues, but they don't actually, or they earn like a piece of the revenue, right? It's a brilliant model for banks, but I'm not quite sure that it's a brilliant model for the tech layer unless they can find a way to do things fundamentally differently, which is to say that the products need to work together. And if you look at a website like Bank of America or any of the large, financial institutions, you see all these different tabs of all these things they do. And we talk about how the 2010s were about creating a startup for each tab, right? It was like, all right, we're just going to create the tab. But the answer now is not to just like create a website and put all the tabs in it. It's to have the products blend a little bit more. It's about like leveraging insurance and investment products, right? Insurance is a financial product. That is a piece of how investment products should work, right? There's like savings components, and it's not just about like issuing a new debit card that people think is cool. It's about thinking about the functionality that people are looking for. And I think the financial institution is being like, I guess, reconstructed more than deconstructed by companies that are traditionally not considered financial institutions. You can look at what Uber's done by issuing cards and bank accounts, and I think you're starting to see that organizations that aren't banks have enough trust with their customer base to where they're able to offer these services and start to like eat at the lunch of the big institutions a little bit.
Yeah, it's a great perspective. Is it enough to just put a great digital experience and essentially a wrapper around core banking technology that already exists? Or do people need to look broader and, like you said, look across sector? How can I provide different types of insurance solutions and banking and wealth management all in one place? And is that feasible in the long run? Or 20 years from now, are you the one getting disrupted because you're now on the legacy technology? Any other predictions for the future of fintech and where there's opportunity for fintechs to disrupt in financial services?
Well, I mean, just kind of riffing on what you guys have said, I do think there'll be a lot of partnerships between single vendors with companies that are more of a platform, because I do think you have to be more of a platform. I mean, to Matt's comment earlier, where Lendio did really well, it gave them greater brand recognition, but is there enough there to satisfy that you could do other things? Do you know what I mean? Or is it just what's their full offering? And I don't know enough, but just in that example, I think in Kristen's example, she's a kind of a platform that can offer many different services. I think sometimes a digital wrapper works really well for an existing institution because it gives the impression of innovation. It serves what the day one requirement is for the consumer to have more of a contemporary user experience, because it takes a while to build the bridge sometimes, whether you're like taking out the legacy system up front or collaborating up front. So I think it's going to be a difficult environment to be a one-trick pony with one solution, and so therefore I think you are going to see a lot of collaborations and within the fintech community, but also the incumbents, whatever. That's my opinion.
Yeah, and Margaret, that's a great point with the bridge, Kristen. I was just going to say, it ties back into your comment on regulation. It's very hard to get a de novo charter for a bank. And, even though there's charters out there for even, a non-depository banking institution, for example, that could just offer lending or what have you, it's been a challenge for fintechs to do that. You've had states, AGs kind of suing those who are trying. And so maybe that regulatory hurdle is, again, the big one, where it's easier today to just create that contemporary experience around a business model that already exists and that has the charter that's needed to not only maybe operate at all, or certainly to operate on a nationwide scale without a patchwork of state laws if you're trying to go state by state. And yeah, Kristen, did you want to add to that thought?
Yeah, I mean, I guess two things. One, on the digital wrapper side, it's part of the one-trick ponies from the last decade were able to exist because digital acquisition was so much cheaper 10 years ago than it is now, right? As the platforms like Facebook and Twitter and Instagram were in their earlier days, acquiring customers was a lot cheaper. I mean, we can talk about it. Like, Facebook is not a sustainable way to build your customer base for 99% of businesses out there, maybe 99.9% of businesses out there. And so the increasing costs of that mean that like the one trick pony, like you can't get the lifetime value out of it anymore. The second thing I'd say on the state by state regulation, I don't know how many people know this, but the SEC created a web brokers exemption in 2002 to allow advisors to sort of file at the federal level if they were sort of a virtual broker. I mean, that is what created robo-advisors. Like that's what created the path for robo-advisors to exist in the late 2000s and early 2010s. And I think we're kind of at that point in insurance now, right? Like Catch is registered in all 50 states. Like just the operational overhead of applying for licenses, getting the like that process is expensive and costly. And then there's like specific regulations that apply to what you can talk about and what you can't. And I think that there's a huge opportunity as we think about this like rebundling to say like, how do we make things more efficient to make it attractive for someone to go into insurance? Like fintech lags traditional tech by probably about 5 or 10 years. InsurTech lags fintech by like at least a decade, right? Like we are just much further behind on insurance.
Yeah, I'd add one last point to that for consideration too. Like if there's anyone viewing this who's thinking about starting a company or mid-flight, with this lockdown, we're going to start seeing layoffs and consolidation like of the traditional businesses that we work with, and just think about the procurement and vendor process on the other side, or during lockdown and the other side of this. So to be a new company and try to get the attention and approval and vetting of some of these people that you need to partner with, that's going to be difficult. And that too, I think, is going to force partnerships or people to come and collaborate, because the vendor procurement groups don't have enough time to actually absorb what every one of these individual tech solutions might be. And I think that's something that people have to be mindful of too.
Yeah, that's interesting. Well, this has been fantastic. I think we've got some time for Q&A. So I'd like to move into some of the Q&A. We actually had some questions that were submitted in advance. And the one I'd like to start with, we touched on a little bit with Kristen's, question that she posed around, you've got all the acquisition costs, let's say, of the challenger or neobanks. You're sharing the economics with a bank behind the scenes. Is that enough? And so I think that's a nice transition into one of the questions that was submitted about scale versus profitability and unit economics. So historically in fintech, you've had a lot of fintechs that have been chasing market share, users, revenues, and some of those might have a long-term model that says eventually there's a lifetime value, and some might say we'll figure that out once we have the market share. Unit economics really aren't a focus for us. So I'd love to hear from someone on the panel about, does that change in a COVID-19 environment? Is it okay to be unprofitable? And will investors wait it out until people can scale and things will go back to that sort of top line focus that we've seen for the past several years? Or is this going to actually represent a longer term shift in how people think about their business model and their unit economics in order to survive the short term crisis, as well as be able to attract funding for scale? And who wants to jump in first on this one? Kristen, you're smiling. You and Margaret maybe both. Kristen, why don't you start us off, and then we'll go to the panel.
I wonder how many VCs are on the call right now, but I guess what I would say is that VCs have always said that unit economics are important and that growth is not as important as having your unit economics correct, but then you kind of like watch the rounds get made and it doesn't always feel like that matches that narrative. And so my personal belief is that unit economics have to be the focus. You need to prove that you can build a scalable channel, but you have to prove that you can make money on your customers. I think that honestly, I don't understand why it was ever any different, but the idea that like you will flip a model that like you're losing money on every customer, and if you just have 1 million customers, fintech is typically not a network effect. There are some exceptions to that, right? I think that like Venmo, and the Cash App, like you can kind of see there are some network effects, but there is a lot of fintech that there is just no network effect. And so the argument that growth is more important than economics is to me a little bit silly. And I think that there will be a little bit less patience for it. I think a lot of the neobanks were pitching in the last 2 years that their LTV was over an expected 10-year return, because they were using metrics that traditional banks had seen for customer retention, right? If you have a savings account with Bank of America, the average customer stays for 10 years. Okay, so they use that proxy, but I don't think that was an accurate proxy for the people who were adopting neobanks and the people who were just like trying neobanks. And so I think that this idea of like, how do you understand what your LTV is going to be and making slightly more conservative assumptions on that, I think is going to have to be the norm. Because you can't just say like our customers are going to stay for 10 years because they stay with Bank of America for 10 years. That's just like that's not apples to apples.
It's a great point. Think about how the switching costs have changed. You know, maybe you stay when it's painful to walk into a bank and open a new account, but these days you can get, you know, an account, whether it's a Marcus savings account or Chime or whoever, in a couple minutes online. So it's very easy to switch. It's very easy to try it out. But are people fully switching? Are they moving their direct deposit over? Are they leveraging the rest of those services, or are they just trying it out? And to your point, the attrition might be very different than the legacy models. Margaret, did you want to jump in with some thoughts, or Matthew?
Go ahead, Matthew, if you want. Do you have any comments?
Oh, I've been talking to a bunch of private equity and venture capitalists about that. We actually had a panel on this topic by itself and the consensus in that group. And I'm president of an angel group here in Atlanta. It is that we think like the likelihood, the private equity people are consensus 100%. We're moving towards EBITDA focused. Like anybody that was kind of bleeding over to revenue focus, we're 100% on EBITDA growth. The VCs, which were 100% focused on just top line and multiples on revenue and paying like that, even the ones that we're talking to, they were leaning towards EBITDA as kind of a barometer, and most of their portfolio companies are moving there. And we're just, even at the angel level, we're seeing just less speculative investing, or it just slowed down. It slowed to a halt for a quarter because people were like reassessing. We did see some Series A deals done in the Southeast, like, you know, at a much lower level, like kind of the ones that got completed. So time will tell, but much more focus on EBITDA than we've ever seen in recent history.
Yeah, and it makes sense. Go ahead, Margaret.
That's okay. I mean, I agree with both Matthew and Chris, and I think that, especially as the founder of a company, it's like one of the most important things that you can measure against. You know what I mean? Everything else is sort of magical math, you know, in terms of like adoption rates and retention rates. And I think that one is something that you can really control. It's the only way you can figure out your margin. And we've always driven from a standpoint of like profitability, that it was super unsexy though. I mean, you can't get these incredible multiples like off of that, right? You can get incredible multiples off of a model that, like, you know, shows extraordinary explosive growth. But I do think it's important. But you know, we require innovation, and innovation isn't usually done by people with trust accounts and, you know, funding it completely on their own. So there will always be the spirit of, whether it's a sponsor incubating or it's venture or private equity, their tolerance in terms of the models that they will be able to absorb as like reasonable like periods of like, you know, this is a good company to invest in and whatnot. That's what I think is going to change. Everyone assumes there'll be a period of where you're not profitable, right? But they have to be able to back into back of the napkin math of how you get there and not need all of these extraordinary events to hit it. So I think that will change.
Yeah, so I think to summarize, I mean, some great advice for anyone who maybe has founded or is thinking about, you know, taking that jump into the startup world and being an entrepreneur. It sounds like looking in the mirror and being honest with yourself about your assumptions and your model. I think sometimes entrepreneurs to succeed have to be optimistic, and they have to sort of ignore the constraints that others see. But how do you balance that with a very realistic view? If you're losing, you know, $1 on every customer, then 1 million customers just means you lose $1 million. Unless there's a big upfront fixed cost and every customer makes $1 and you just need a certain number to cover your fixed costs, that's a different story. But as we've said with these fintechs, a lot of times the upfront fixed cost really isn't there. It's low, and the cost even of things like AWS are more variable. So really interesting for people to be thinking about, you know, hey, historically, the reward might not be there. I think about my space in lending, where you've got public companies that are very profitable, worth maybe 1x revenue, sometimes less. And then you've got, you know, private companies that are trying to disrupt that space, worth 20x revenue with, you can't even do a multiple. You know, public companies 4 to 6 times EBITDA, private companies, EBITDA is negative. So I don't know. Really interesting. I want to tackle a quick question that we got from the audience live, which was, how have your organizations thought about leveraging automation in the wake of the pandemic? And I'll give a quick answer just for our organization, and I'd love to hear if others have changed. You know, for us, I will say we've always tried to move fast, and we have been focused on profitable growth, always unit economics, but certainly still growth. So in the lending space, that's been a lot of focus on marketing analytics. How do we target and acquire the right customers? And then underwriting. How do we fund those customers and use some new techniques like, you know, cash flows instead of just trade lines. And so we've neglected some of the servicing side that we know is manual and could be more automated. For us, we've definitely shifted, and we have initiatives that were in our roadmap for, you know, 6 to 12 months down the road, or kind of just stuck in an icebox or backlog that we're now tackling. So we've been automating as much as we can. You know, we had a call center of 100 people in the Philippines that went to 30 overnight. With the automation that we've done to get back to that same scale, we might actually only need the 30. And so one silver lining out of this is that when it's time to grow again, we'll be much more efficient, you know, than we were historically from an operations standpoint. And I'd love to hear from the panel if any of you or your clients are similarly focusing on leveraging automation in the wake of the pandemic.
I think for us, it's even broader than that. So because we have a big people component and automation component, so we've focused on our workflow in general. With everybody being remote, we have this growing need for collaboration and some organized way to create workflow. And you know, you could turn somebody in the office and say, "Hey, can you take this? Can you help me here?" So we've invested a lot of time in our workflow tools in this time, which has begetted this automation. Oh, we can automate that piece of this, and maybe we don't need to hand that off. But there's a collaboration component to this that is really crucial, I think, for all of us going remote, especially if you're new at remote. That there needs to be a focus on is how do we create cross collaboration with the tools that are out there.
I would say it's almost been the opposite for us, and maybe this is just about business size and stage and like where you're at in the life cycle. But I think we very early on focused almost exclusively on things that we could build with API integration, right? Like we built a health insurance integration that allows us to serve 38 states of health insurance through API. Like that's unheard of for most companies our size, right? But I think when this hit, we actually had a bit of a moment of like, raising our next round of venture funding is going to be more difficult. We have to be answering the really tough questions quicker of like, are we finding product market fit, and less of like, will this thing scale to 38 states? And so there are certain things that we've done that are actually far less automated than we were doing in the past, because we just need to get answers. Like we have a feature that we think customers will pay for and we're not really sure. We could build it out with our bank partner, or we could sit for a weekend and mail out checks ourselves. What we're doing first is we're going to mail out checks ourselves to see if customers are going to pay for it. And then we can talk about building it. So we've actually kind of like flipped the model a little bit, because the urgency has been around like, you need to prove out these unit economics. You need to prove out that there's value to what you're doing, and less of the like build for the ideal world. So I think that, you know, some companies, again, depending on where you are in the stage, automation is great, but at the early stage, it's been really important for us to like realistically look at the market and say that the fundraise is going to be important for us, because we're not at profitability and we're not going to be in 6 months. And so we have to like get those answers from our customers and not worry about like whether or not we can do it for 10 million people, because it doesn't matter right now.
So like most answers in life, I think the answer is it depends. Some things maybe you want to kick off manually to learn very quickly and just adapt, and other things you can maybe automate to save money. I think we're about out of time. So I do want to thank everyone for joining today. Definitely a huge thank you to the panelists for sharing their expertise, as well as to everyone in the audience who has spent this hour with us. And let me go ahead and pass it back to Layla to close out.
Thanks, Stephanie, and great job, guys, all panelists. Thank you so much for your time and expertise today. I personally thought it was a very engaging and interesting conversation on the state of the fintech space in today's climate. So great job there. I also wanted to thank all of our guests for joining today's webinar. I hope you enjoyed the discussion and are leaving here with more information than we came with. If you have questions about the current state of the tech job market and how that impacts you, please don't hesitate to reach out. At Motion Recruitment, we're here to help in any way we can. That being said, we'll share the resources and recording with you after the call. I know I'm definitely going to go back and listen to a few of these key points, so stay tuned for more resources in your inbox. Well, I think that's all from me. So I just want to say thank you again to all the panelists and to all the guests that listened in today. And have a great day and stay safe out there.
Thank you. Thanks, Stephanie. Thanks, guys. Bye.
Bye, thanks.
All right, thank you.